So as we move into the end of this year, we've gotten the easy part of the rebound. We saw that in the third quarter. We saw manufacturing improve. We saw housing do phenomenal. We saw the consumer pick up. Now the hard work is beginning for economic growth. Now we still have some segments of the economy that are doing very well. Manufacturing, for example. Manufacturing has reached levels that we haven't seen since prior to the pandemic. And that's primarily because of the fact that we've had to replenish a lot of backlogs of orders when the manufacturing plants were shut down. So we've got a really strong recovery that's continuing in manufacturing. Housing has been phenomenal. If you look at this chart, the 30-year mortgage rate continues to make record lows. So as that's continuing, you're seeing home builder sentiment rise to a record high. Consumer spending was a little bit choppy in the third quarter, but what's optimistic about the spending side of it is that consumers are spending on big ticket items, not just necessities. Typically, when you're coming out of a recession, consumers are really only spending on necessities. But what we're seeing is they're spending money on autos, furniture, electronics. These are big ticket items, and typically you don't spend money on a big ticket item unless you have confidence on what's going to happen in the future. Lastly, fiscal stimulus and monetary stimulus continues to support the economy, and it will continue to support the economy going forward. The Federal Reserve continues to expand their balance sheet. It's over $7 trillion now. The federal government put a majority of the stimulus in the first half of this year. We're looking for another stimulus package to come out, whether it's before or after the election. When we say the hard work begins, there's a couple areas of the economy that we think will take longer to repair from the pandemic-related lockdown. The first one is the labor market. In 5 months, we've gained back about half of the jobs that we lost, but that's just not quite enough yet. We still have an elevated unemployment rate. We still have elevated initial jobless claims. And if you look at this chart, we still have the amount of people that are long-term unemployed, or those that are unemployed for more than 27 weeks, that's still rising. We are seeing women leave the labor force at a staggering rate because they're forced to choose between teaching their children at home or going back to work. We need to get a little bit better consistency with the improvement in the labor market to get more clarity around what the future growth will look like after we've experienced this V-shaped recovery. Personal income is struggling. We got a pretty big bounce in personal income because of the fiscal stimulus checks, but we've seen several months where personal income is declining. We've also seen that the savings rate is coming down a bit, and when you're talking about a little bit of uncertainty around growth, that cushion is good to have. So we want to see incomes improve. We think that fiscal stimulus can help in that area. The last area that we're just monitoring is the bankruptcies and the delinquencies that are rising. We have seen that even though we have a foreclosure and eviction moratorium in place, delinquencies on mortgages are rising. We're also seeing bankruptcies, specifically in the retail space, rising at a pretty rapid pace. So those are some areas of the economy that are still struggling a bit. We think going forward that the stimulus the government's done will help us continue to grow. However, we do need more stimulus. We need to continue to see improvement in the labor market. And as we're navigating through this and repairing that labor market, we think that the recovery going forward will be a bit choppier than we've seen with this V-shaped recovery coming out of the second quarter.